Welcome to the Deep Dive, the show that, well, cuts through the noise and gets straight to the insights you really need.
That's the goal.
And today, we're jumping into something pretty fascinating, actually. It's a real market paradox involving AST SpaceMobile's Q2 2025 earnings.
Hmm.
Because here's the kicker. This is a company that, you look at the paper, they missed Wall Street's revenue and earnings targets. Like, significantly.
Yeah, quite a bit off.
And yet their stock price jumped in after-hours trading. It just doesn't immediately make sense, does
It
it?
really doesn't on the surface.
Yeah.
It's one of those head scratchers.
Exactly. So that's the puzzle we're here to solve for you today. We're going to unpack exactly why that happened, and maybe more importantly, what it means for how you should think about these pre-commercial, high-growth type companies.
Right. And for this deep dive, we'll use a structured approach, looking at the earnings release piece by piece. We'll take the company's data, mesh it with what the market was expecting, and really try to pull out the underlying story. The aim here is to get past just the headline numbers and give you the key insights, what really matters for a company like ASTS at this stage. Ambitious, pre-revenue, it's a different ballgame.
Definitely. We want to equip you with that perspective.
Okay, then.
Now for slide 1, the at-a-glance scorecard.
Let's get into it.
So, right off the bat, let's not mince words. If you're just looking at the core financial results against estimates, well, it looks like a clear miss, doesn't it?
Oh, absolutely. Yeah. By the traditional metrics, no question. If we look at the specifics, the numbers are pretty straightforward on that front, at least.
Go on.
Okay, so revenue came in at $1.156 million. The Wall Street consensus, though, was quite a bit higher. The estimates ranged from about $5.15 million up to $6.02 million. So, yeah, a substantial shortfall there.
Big miss on revenue. And earnings.
Same story, really. The reported diluted loss per share was 41 cents, $1.41. The consensus was looking for a loss of 19 cents, $2.19 per share. So, again, missed the mark. Looked like a double miss by conventional standards.
And yet, here's where it gets, really interesting. Despite missing on both top and bottom lines, AST SpaceMobile shares were actually jumping in after-hours trading right after they dropped this news.
Exactly.
It's just such a compelling paradox. How does the market react positively to what seems like, objectively negative news?
That is the absolute crux of it. And to figure it out, we can't just stop at the headlines. We need to dig a bit deeper, look at the internal numbers year over year. They paint a more, let's say, nuanced picture.
Okay, let's see it.
So total revenue, while small, did actually increase year over year, up 28.4% compared to Q2 last year. So $1.156 million this quarter versus $6.9 million back then.
Okay, some growth there.
But their net loss attributable to common stockholders, that actually grew, widened by 37.0%. It went from about $72.6 million last year to a larger loss of $99.4 million this quarter.
So bigger loss overall. But you said there was something counterintuitive.
Right, here it is.
Right.
Despite that bigger net loss, the diluted earnings per share, the loss per share, actually improved. It shrunk by 19.6%, going from a loss of $2.51 last year to $2.41 this year.
Wait, hold on.
Yeah.
How does that work? The total loss gets bigger, but the loss per share gets smaller. That feels like financial magic or something.
Yeah, not quite magic, but it's a really critical concept, shareholder dilution. It's super common with these high-growth, capital-hungry companies.
Dilution? Okay, explain that.
Think of it this way. The net loss, yes, it's bigger in total dollars. But AST SpaceMobile also issued a lot of new stock to raise money over the past year.
Right, they need cash.
Exactly. So the weighted average number of shares outstanding went up massively by over 71%, actually, from around 141 million shares to almost 242 million.
Ah, okay.
So that bigger net loss is being spread across a much, much larger number of shares, like dividing a bigger pizza among way more people. Each person's slice, or in this case, each share's portion of the loss, gets smaller.
So it's more about the math of the share count changing than the underlying business suddenly becoming more profitable operationally.
Precisely. It's a mathematical artifact, largely driven by their financing activities, not a sign of improving operational efficiency just yet. And that connects directly to why the market reacted so positively.
Go on.
For a company like AST SpaceMobile, pre-commercial, needing tons of capital, the single biggest risk, the existential threat, isn't missing tiny revenue numbers today. It's running out of cash. It's the financial runway.
Okay.
And the headline within the earnings release, the real news the market grabbed onto, was the announcement of a fully funded plan. They secured backing for over $1.5 billion in liquidity through major financing deals.
Ah, the funding.
That was it. Investors saw that the near-term funding risk, the danger of running out of money before the satellites were up and running, that risk was basically eliminated. And they valued that security, that de-risking, far more than they cared about the miss on negligible Q2 revenue and EPS figures. They're betting on the future plan, which now looks funded.
That makes complete sense now. So for you listening, when you're looking at these early stage companies, especially in deep tech or infrastructure, funding security isn't just one factor. It can be the dominant factor driving the stock,
Yeah,
right?
absolutely. Without the cash, the best plan in the world is just paper.
Yeah.
The market saw the mission, got funded, and essentially said, okay, proceed.
Okay, super insightful. Let's shift gears. Moving to slide 2, the engine of profitability. Analyzing a pre-commercial cost structure.
Right.
So we've established the funding is key, and they secured it. But that money isn't just sitting in the bank, presumably. They're spending it. So let's unpack that. How do we analyze costs for a company that isn't really focused on profit yet?
Exactly. Traditional profit metrics like margins, they just don't apply here. The focus has to shift entirely to the cost structure itself and, critically, the cash burn rate. You need to see where that essential capital is actually going.
And what did we see in Q2?
We saw a pretty notable step up in spending. Total operating expenses rose to $74.0 million in Q2, which was up from $63.7 million in Q1. So they're clearly accelerating things, pushing forward on building and deploying that satellite network.
Makes sense. They have the funding now. So what specifically is driving that increase? Where's the bulk of the cash going?
Well, it lines up pretty clearly with their strategic goals, the massive task ahead. The biggest slice was engineering services cost that hit $28.6 million. That's the core tech development, the build-out.
Okay.
Then you had general administrative G&A costs, also significant at $27.2 million. That reflects scaling up the corporate side, getting ready to be a global operator. And finally, research and development R&D at $6.4 million.
So heavy spending on the engineering and just building the company itself.
Exactly. It shows a dual focus, tackling the huge technical challenge of the network itself, while also building the business infrastructure needed to actually launch and run it globally. It's building the plane while flying it almost.
Now, management also pointed to a non-GAAP measure in their release, adjusted operating expenses. We hear GAAP and non-GAAP all the time. Can you quickly break down what GAAP is versus non-GAAP and what ASTS adjusted for here? Why show that other number?
Sure. So GAAP, generally accepted accounting principles. Those
Yeah.
are the official standardized accounting rules. Everyone has to follow them for consistency. That $74 million operating expense figure we just talked about, that's the GAAP number.
Got it. Official rules.
Non-GAAP figures, on the other hand, are alternative calculations that management provides. They argue it gives a, let's say, clearer or different view of operational performance, usually by excluding certain items.
Okay, so what did ASTS exclude?
For their adjusted operating expenses in Q2, they started with a GAAP total of $73.95 million. Then, they backed out or subtracted two main non-cash charges. First, depreciation and amortization was $11.72 million. That's an accounting charge reflecting assets losing value over time, not cash going out the door this quarter.
Right, non-TAC.
And second, they subtracted stock-based compensation, which was $10.53 million. That's paying employees with stock options or grants, again, important, but not an immediate cash outflow.
Okay.
So you take the $74 million GAAP expense, subtract those two non-cash items, and you land at their adjusted operating expenses, non-GAAP, of $51.71 million.
Okay, so $51.7 million non-GAAP versus $74 million GAAP. What's the point of showing that lower number? Is it just to make things look better?
Well, management's argument, and there's some logic to it for a company like this, is that the non-GAAP figure is a better proxy for their core cash spending on operations.
Ah, the actual cash burn.
Exactly. For a company like AST SpaceMobile, living off its cash reserves until revenue ramps up, understanding the true cash burn rate is critical. That $51.7 million gives you a clearer picture of the actual cash leaving the building for day-to-day stuff, salaries paid in cash, materials, services, etc. It helps assess how quickly they're using that funding we talked about.
That makes sense. It's not hiding anything, just offering a different lens focused on cash flow.
Precisely. You always need to look at both GAAP and non-GAAP, understand what's being adjusted and why. But for a pre-revenue company managing cash, that adjusted figure can be quite useful.
Yeah, super important distinction for you, the listener. Understanding these non-GAAP adjustments helps you see how management views their cash burn, which is often the most critical metric at this stage. All right, now for slide 3, the engine room business segment performance.
Moving right along.
We've hit funding, we've hit cash burn, but what about the actual work? what does all this spending mean for, building the network in space? ASTS doesn't have traditional business segments selling different products yet, so how do we gauge their real operational progress?
That's a great question. You're right, there are no neat revenue lines by product segment. So you have to evaluate their performance based on hitting milestones within their core operational pillars. Think of it as manufacturing, launch, spectrum access, and commercialization efforts.
Okay, those four pillars.
And the key takeaway from Q2 is that they showed tangible, measurable progress across these areas. It shows they're executing on that interlocking strategy needed to actually build this thing.
Let's zoom in on one of those. What about manufacturing? That seems pretty fundamental.
Absolutely fundamental. And they reported a really key milestone there. They completed the assembly of these things called microns. You can think of microns as like essential building blocks, tiny antenna elements for the big phased array antennas on their next-gen Block 2 BlueBird satellites.
Okay, complex component.
Very. And they've finished assembling enough of these microns for 8 of those Block 2 satellites. That's significant because it shows they're mastering the manufacturing process for this complex, critical technology that needs to work flawlessly in space.
So real tangible output from the factory floor.
Exactly. And they're not stopping there. They stated they're on target to finish making enough microns for the equivalent of 40 satellites by early 2026. So it demonstrates real momentum in the manufacturing pipeline, which is absolutely crucial for their launch plans and scaling the whole network.
It really paints a picture of just how complex this is, right? Building something entirely new, step by painful step. You mentioned this interlocking strategy. How does progress in manufacturing, like making these microns, connect to the other pillars?
That's where it gets really interesting. And it shows the integrated nature of their plan. Progress in one area directly enables or strengthens the others. It's not siloed. Well, manufacturing progress, like building those microns in satellites, obviously directly enables their launch plans. You can't launch satellites you haven't built. Simple as that.
Right.
Then, the value of those satellites once they are launched is entirely dependent on the spectrum access they've secured. Without the rights to use the airwaves, the satellites are just orbiting hardware.
Understood.
And, critically, the commercialization efforts, signing deals with major mobile network operators, getting government contracts that provides the market validation. That validation was absolutely essential for them to secure that huge $1.5 billion plus financing package we discussed earlier.
So the deals helped get the money.
Exactly.
Yeah.
And that financing, in turn, circles right back to funding more manufacturing and more launches. See how it all connects?
Yeah, it's a cycle.
It's a totally integrated strategy. Success in manufacturing helps launches, spectrum gives value, commercial deals bring validation and money, which funds more manufacturing and launches.
Yeah.
They seem to be managing that complex dance quite effectively right now.
That's a great explanation. And for you listening, it shows how all these different parts of a complex tech venture, R&D, manufacturing, finance, market strategy, they have to work together. It's not just one piece, it's the whole system moving forward. Okay, we've definitely covered a lot of ground today. Obviously, the full earnings report goes even deeper, but in this dive, we've really tried to unpack that initial scorecard, that surprising market reaction,
A funding story.
drilled into the costs and the cash burn dynamics for a company like this,
The non-JAP view.
and highlighted some of those key operational steps forward, like in manufacturing.
Right. And maybe a final thought to leave you with. When you're looking at companies like AST SpaceMobile, success right now isn't measured by profit in the traditional sense. Not yet, anyway.
What is it measured by then?
It's measured by de-risking the future. It's about securing the funding they need and then hitting tangible operational milestones that show they are making concrete progress towards their very ambitious goal. So, you need to look past the standard P&L and ask, are they building the capability? Are they meeting their technical targets? Are they executing the plan step by step? That's where the real story is for now.
Excellent point. Are they actually building the rocket and getting it ready for launch? Okay, important reminder, this is not financial advice. Please do your own research.
Always.
And this deep dive was generated by AI. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.